Do you want to learn Elliott Wave Theory? Well, if so, consider joining the Green Star Trading Patreon at Tier 2 or Tier 3. You will unlock this playlist, 14 video part series teaching you Elliott Wave Theory from scratch in a simple and easy to follow manner. You'll also get access to other playlists such as the My Chart series showing you how to set up my chart the same way I do with the same indicators and tools configured the way I use them. Also, I've now got a second series of this which will cover all of the classical analysis techniques I use. We've started with episode 1, part 1 and part 2, support and resistance, but we'll be covering volume profiling, candlestick patterns, indicators, all sorts of things to come over the following months. I also have my deep dive videos as well, which I'm now currently doing a second part of a new one which will be uploaded to here soon. And I also have a trading playlist showing you how to use the standard trade setup, the STS, and a little bit on psychology and risk management as well. You can unlock all of these things by becoming a patron today at either Tier 2 or Tier 3. There are some other benefits to joining Tier 3, or you can just support the channel at Tier 1 for a £5 a month. Either way, I'm not going to read it all out to you. Follow the link in the description box below of the video you're watching now. Come over, have a read for yourself, and if you want to sign up, please feel free to do so. I would always recommend signing up at the start of the month so you get a full month's value for your subscription before Patreon charges you again. Alright guys, let's get back to the video. Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right then, it's time for a stock market update. We're going to be looking at our proxy for the S&P 500, which is the SPY ETF. We're going to be looking at the PCC, put the call ratio and the VIX today. Firstly, let me apologise for any background noise here in the office. I've got the fan going to try and keep me cool. I honestly haven't been in the office the last few days. The heat has been intolerable. I've been in constant contact with my patrons and on the Discord, keeping them informed, but I haven't really been able to do any real work in here. It's just been too swelteringly hot. It's now finally ticked down to a reasonable temperature, so this is the first video I've been able to get out this week. Right then, so on that note, let's get started. We're going to be looking at the Elliott wave counts first, and we're going to start with the alternate count, which is the idea that the market has bottomed. Not a very popular idea, it would appear at the moment. The consensus, in my opinion, over the last few weeks and month has been that there's a lot more pain to come. Everyone's very bearish and things are going to go very lower. Now, if you are going to post on my comment section, your count is wrong, your technical assessment, your Elliottitian assessment of the market is wrong because of fundamental reason ABC, don't even bother, I'm going to delete it. Okay? And the same is true for the primary count. I'm not interested in your fundamental argument and to why you think it supports a count or not. We're supposed to be, as Elliotticians and technicians, ignoring the fundamentals and focusing on chart data. So what we're going to do first in this video is we're going to get the fundamental discussions out of the way, put those to one side, express them in support of either count, because that seems to be how a lot of people unfortunately think, but we will justify it either way and then we will move on. So if you don't want to listen to the fundamental reasoning here, use the time stamp and just skip it. So let's discuss that first. Okay, so fundamental argument number one to support the idea of the alternate count of the market having bottomed. Simple as inflation's peaked. Core ticked down this month, CPI was still elevated, but that was a sign that inflation has peaked. That's going to be interpreted, being as the market is a discounting mechanism and prices things in before, or prices things in preemptively, that's going to be interpreted that Fed policy is functioning, it's working, it's having the desired effect, and the CPI will tick down over the next 3 months as we head into the FOMC in September. Everything's hunky-dory, back to the party chaps, nothing to worry about, inflation was transitory all along. There you go. There's a fundamental argument as to why the market's bottomed. So, let's have a quick fundamental discussion about why it hasn't. Okay, and the second fundamental argument in support of the market going much lower and the pain getting much worse is inflation has not peaked. It remains stubborn, aggressively so, and over the next 3 months as we head into September and the FOMC meeting, the CPI readings that come out will prove that, if that's the case. Now, under that circumstance, monetary conditions will remain tight, in fact get tighter. Rate hikes will continue to go up, 75 basis points, 100 basis points, and more of them than expected. Under this scenario, the wealth economy that we have built over the last 14 years, the wealth effect economy, will go up in smoke. Equities will go up in smoke, and along with it, the 401ks of an entire generation of retirees who've recently left the workforce over the last 2 years, along with their pension funds also going up in smoke. They will try to return to a workforce which doesn't want them or can't employ them, and won't be able to because the economy is contracting so goddamn rapidly no one can believe it. We've seen these precursors, the warnings of this in the ISM, with the Price Managers Index and the new orders, which is the leading indicator of the ISM, ticking down since Q4 2021 and continuing to get more and more severe. Meanwhile, inventories are building. These are all signs of belts getting tightened and monetary conditions getting more and more severe. Now, in this circumstance, we go into a massive global recession. Deficits expand. They just balloon. Along with it, the national debt, which is the major problem in the scenario of long-term rates being elevated, gets severely worse. The economy falls into a depression that it cannot get out of because there's just too much debt load, which is expanding by the day as claims continue to rise, unemployment skyrockets, public spending and government spending goes through the roof. Now, in that scenario, you either believe one of two things. You either believe it was all worth it because we had 8% inflation and that had to be stopped, or you believe that the Fed will lose their nerve and pivot regardless of the threat of further inflation. That's what I believe. Now, I might be wrong, you might be right if you disagree, but that's what I believe. I'm cynical enough about politicians, I'm cynical enough about central bankers to believe that the long-term goal has never been to pay the debt. Ever. It has never been to default on it. Ever. It has always been to devalue it, to inflate it away. So we have to fight the good fight in the short term. We have to save face in the short term. We have to be seen to be doing the right thing, but that is not the long-term goal. The long-term goal has been inevitable, in my opinion, and that is to inflate the debt away. So the choice on the knife edge that the Fed is trying to maneuver over, trying to walk at the moment, is cause severe pain for a generation or short-term extreme agony. So which would you choose? Do you want short-term agony or do you want long-term pain? I think their bluff will get called and they'll go with the short-term agony. So I'm not predicting a hyperinflation before you get out your Weimar Republic history lesson, but high inflation, I mean high inflation, sustained for a year, 2, 3, 4 years maybe, will destroy the national debt, will halve it, right? Or even bring it down to 30% or so, which then makes all of the responsible monetary policies you've always dreamed of being able to implement possible. They are not possible at the moment. They're just not. Not with the debt load that we've got. Not with the fragility of the credit markets that we've got. They will either push us into that global recession until they pivot out of the pain that they cause, or they will break something before we get there. So we'll have to wait and see. But there you go, there's the second fundamental argument. So we've expressed them, we've spoken about the elephants in the room. We don't need to discuss them in the comment section, and we certainly don't need to relate them to your particular minute or minuet count on this time frame, Tom, and how it relates to fundamentals, because it's not important. We're now just going to come and have a look at the chart. Right then, so looking at the alternate count first, we have a zigzag here. This is when things were looking not too great, but they weren't nightmarish, potentially nightmarish yet. Hence, it's not an unsubstantial zigzag, but it's not as big as this one, which is the second zigzag. So we've got W and a Y joined by a flat X wave, and it's all done. Okay, we're complete where we are at the current lows. So let's come down to the 8 hours so we can get the smaller detail here. Nice, I'll tell you what. Let's come down to the hour chart. Look at this low. Because you either look at this as a free wave correction, or you could argue that the free waves has already occurred and we're still going higher, or you can look at this as a bullish move off of the low. with 5 waves, 1, 2, 3, 4, 5 into a 1, and then you've got an A, B, C flat pattern into a 2, and now we've gone 1 and 2 again, and we're entering a 3 at sub-minuet level, and we should be on our way. Okay, now if that's the case, let's have a quick look at what's ahead of us here. We've got resistance obviously around these previous highs. We've got these huge gaps in the volume profile. We're just bumping into a little supply zone here, right, that we're currently in. This area here, which is around previous resistance. If I just bring up my support resistance here, we're testing that high at the moment. Pre-market we're down slightly as I'm speaking to you. We're in this little supply zone here, so we could reverse here, possible. Short-term invalidation of this count then would be the low here, assuming that that is 1, 2, 3, 4, 5 smaller waves, so this would be an invalidation point. We will just get our text and we'll save that there. So sub-minuet invalidation. Oh my god. Okay, invalidation. Excuse me, I've got a bit of a frog in the throat at the moment. Sub-minuet wave 2. Let's pop a price on it. Okay, short-term invalidation 380.67. Long-term invalidation of this being the low is of course the previous low of 362.16. If we break that low, this was incorrect. We did not bottom here. This was not a 1 and a 2. Okay, 362.16. If we do get out through this local resistance, the next target will be this supply zone up here around the previous high. Okay, and this is currently at 417.44, this level here. And then we could, well, you could be stepping up 3, 4, 5 into a larger wave, 4, 5. Any move continuing higher from this point, we're going to get such a large wave here by comparison to this move here, but the idea of it being corrective, of course, starts to break down. This is the high we would need to break to invalidate the bearish count. We'll see that in a moment. And then there's a whole bunch of other support and resistance levels that we've got to work our way up through, which we will. We'll go 1, 2, 1, 2, 3, 4, 5, 3, 4, 5, 3, 4, 5, 1, and then come back for a 2. So it's all ahead of us, even if we have bottomed. So that's the alternate count, WXY, into a low that is 5 up into a 1, ABC into 2, 1, 2. We should, in this is correct, accelerate further. Let's come out to the weekly time frame now for a moment and get rid of these support and resistance levels again. We're just going to turn off the count and we're going to see if there's any. There's our invalidation point. Let's grab that and put that into the alternate count. So bring up our indicators. Weekly time frame. Very bullish candle there, long wick to the downside. That low, all the low has been intact. The low of that candle is intact. The close, the low of this candle is intact. So we are just at resistance at the moment, looking to see if we can move higher. So let's bring up our volume for a moment. So move off of the low, arguably not supported at the moment. We'll see how this week's candle closes here with the volume. But to be honest with you, once we get off of those lows, volume stays low and actually rallies on declining volume. This just seems to be the norm here. If we look at the MACD, we're close to getting a cross of the signal over the average here, potentially moving back into bullish momentum. So a break of local resistance, a weekly cross on the MACD, a return to green bars on the histogram here, a sign of momentum turning around could be very positive. Then we'll be looking for invalidation points in the next count in a moment. MACD, we've spoken about. RSI has done a round trip from overbought back around August 21 all the way down to oversold in May 22. And on the weekly time frame, we have seen divergence at the lows in the RSI. Bullish divergence between these two lows. Normally going from overbought to oversold on the weekly time frame is enough to bring about a major market correction. So let's take a quick look. Let's bring up our VIX and PCC extremes, and I'll show you some examples. So overbought to sorry, I need to get my little drawing tool. Overbought to oversold, round trip, market bottom. PCC and VIX confirm it. Overbought to oversold on the weekly time frame, PCC confirm it, low in. Okay, overbought, didn't quite make it to oversold here. Right, no extreme with PCC. Now this was a much longer topping process back here, but we did still get the same. We went from overbought all the way back here, huge bearish divergence, to oversold. PCC and VIX confirm the low. We move up, we move back, strong bullish divergence, make one more low, and then we rally. So that's an option. You can always make another low and get the divergence there on the weekly. Let's remove all these brushes. But as you can see, doing this on the weekly time frame is normally synonymous with putting in a market low. Right. Dark red bars down in the histogram, light red bars coming back up, back into green. Dark red bars down in the histogram, light red bars coming back up, back into green. Dark down, light up, back into green. Dark down, light up, about to go back into green, about to cross. So there is evidence that the market is bottomed here. Okay, on that note, let's now come and have a look at the... I'll come and do the same for a moment in the primary count, because the primary count does not have this supporting it, you see. So that's why I'm flip-flopping a little bit between them at the moment. We've spoken about the round trip here in the RSI. We've spoken about the MACD preparing to cross over. We've looked at the profiling here in the MACD's history on the histogram, which suggests that we might be about to turn positive. If we come and have a look at the PCC, the long-term trend line that we've followed since 2011, we come back to it. We've missed it here before as well. This time we've gone a little over it, but we're backing away from the highs now. So as you can see, the peaks at the highs are not around for long. They're not a long period of time we spend up here. So maybe we've already done it. Maybe we've peaked. Right. Inflation has peaked, along with fear and panic. Everything's good, boss. Right. That's the attitude. Now this could go, and it could all, and we could be looking at something like this again. Okay, and the bullish and the bearish count is correct, but I'm just pointing out, and we're starting with the alternate count because there is evidence to support it. Right. So now let's come back to the SPY again, and let's walk our way through the bullish count, shall we? Sorry, the bearish count. Excuse me. Let's come back to the daily time frame. Bring up our primary one top and our primary count. Now this one is much more aggressive. 2 is way down here, and this is not a target, so don't pay any attention to the symbols down here. Right? I never put symbols in the future at price targets when they're clumped together. I literally just put them there to get them out of the way. So in this case, the first zigzag, small, it's a temporary hiccup, it's a temporary blip, don't worry about it guys, it's the same, but the second zigzag is a total meltdown, which is going to get considerably worse and be inordinately larger than its twin. Oh, it's not its twin, it's relative. So here we have A, B, but instead of C, shorter C, and 1 and 2, we have A, B, 1 and 2 of the C. Invalidation point is at 417.42. We break that, and we will be coming out of this channel, and we will be supporting the bullish count. In fact, the alternate will become the primary count, and I will have to work on a new alternate, because you always should have a backup. Let's come down to the 8-hour time frame here. So expressing this as a move down as a 1, we have an impulse. We can see here. Let's come down to the hour time frame actually. So a nice clean impulse down into the low. So this was our bottom in the bearish count. Here it's simply 1 2 1 2 1 2 3 4 3 4 3 4 5 1. Minute degree A, B, C. Now if this is the case, and this is still the same 5-wave subwave here, which I suspect it might be, then we're working on a zigzag rather than a flat. Okay, because this is 5. This is still a flat, ABC, right? The B wave is a flat, so that would become sub-minuet. Oops, a daisy, bear with me. Right, and now we're going to get 5 out. So we're still going to get the same price action, but it's going to end. Instead of being 3 into 4 into 5, 3 into 4 into 5, so on and so forth, it's going to come in before the invalidation point here, and then we're going to roll over. So let's have a look at what we've done so far. Right, so 50% retracement was resistance, and 50% was resistance again, and was resistance again. So 50% retracement kept operating as resistance. We've now broken it. Golden ratio is above us. Doesn't look like we've got room to squeeze in 5 waves. So a deeper correction into the 78.6 or the 89%, bringing us very close to the previous highs. A bit of a bull trap if this is correct, right? You're drawing in liquidity. You're drawing in liquidity just to turn the market around. So that's the more bearish case. We're just getting started. We're into the wave 2. We've got the gigantic wave 3 to come. And then we've got 4 and 5 lower before we even complete the C of the final zigzag. And price targets will be very, very bearish under those circumstances now. So we're not going to predict those until this correction is in. And at that point, we're going to confirm it when we break the low back here. So invalidation point for this bearish count. Let's just go over that again. 417.42. Invalidation for the alternate. 362.16. We're in this level between this high and this low, and whichever way we go will determine what we're doing. Okay. Right, so let's gather those up now and put them into the primary. They go into the primary, don't they? That's right. So yeah, I'm still favouring just the primary count, that everything's going to unravel and things are going to get really ugly and we're going to go a lot lower. But I'm also much more open to the market having bottomed than I was. If I see price action which is aggressively bullish and takes out that alternate and takes out that primary wave 2 invalidation point, then I'm going to be backing the bullish count that the market's bottomed. Okay, I will be looking for an alternative to explain how it could still go lower, but that would take some time for me to figure out. So we've spoken about the long-term view on the indicators. Let's just come back out to the weekly time frame for a moment, do a little bit more classical analysis. So as I pointed out, we have an alternate count which genuinely does seem to have more short-term support for being correct on the longer time frame, excuse me, on the weekly time frame, to give us the impression that it could be complete. Okay, back to cross on the MACD, round trip on the RSI, divergence on the weekly time frame at the bottom. Day time frame, we don't see as clear if, well, there's a marginal divergence, and it is marginal if it's there at all. It might not even be there. OBV continues to tick down. There was bullish divergence just about on the MACD between lows, but we're still not above the zero bound yet. We're at the 60 exponential moving average on the daily, so we've got pressure above us. We know there's resistance here. We've spoken about it. Support and resistance levels. Now let's look at some market geometry then as well. So, a couple of pitchforks for you, both originals. So this one is taken off a primary pivot, right? Dominant pivots high, swing low, swing high, bump, bump, bump. Instead of the Elliott wave pivot, which is here because this is a flat. So we're just using the dominant pivots here with this pitchfork. And we've come down to the 38.2 and the median line, come back up to the edge of the pitchfork. We tested the edge of the pitchfork here, here, here. We're testing it again now. A significant break of this pitchfork in a 5-wave move, breaking prior resistance, that's going to look like a 1 on a larger time frame to me. I will be looking for a retracement for 2, and at that point, because we're coming back on the first prior the prior low, and this will be the first higher low, this is when sentiment's going to become the most bearish. So people are going to be like, if you do this, if you do go 1, 2, 3, 4, 5 into 1, this is when everyone's going to be getting bearish again. But it's actually 2 before this. Okay, so that's what I want to see on the larger time frame. Let's have a look at this other pitchfork. This takes the Elliott wave pivot, and under this circumstance we've already broken it and back tested it. Okay, so this is W, this was X, and this was Y, and then now we're going to move higher, and then we can look at it. How else can we look at it? What else have we got here? Let's try and put a channel. We've got a regression channel, I think, or we did have a regression channel. I don't know where that's gone. It may have just been inside of the primary count. So let's put on a new one. Have I moved it? There's the trend base. There's the parallel channel. There it is, the regression channel from the high. As you can see, we've got a lot more work to do before we clear this thing. Get through the 60, get out of the channel. 250-day exponential average is up here now. We've had the death cross here, the 60 over the 250. As always, it is synonymous with a low forming, but it was only temporary before moving lower again. Sloping down, fundamentally bearish looking views. 60 sloping, everything sloping down over the long term, having rolled over. So all of that's looking pretty bearish. On the weekly time frame, the 250 is coming up to meters. We're not far off of it. But things are always darkest before the dawn. We saw that back here in the COVID crash, back in 2018, and then back in 2015. Okay, came down towards and close to the 250, close to the 250 through it. We're close to the 250 again. That exponential moving average. So are we close to finding a bottom? Alright then. We've already discussed the PCC. We've come in back to this trend line here. We could be reversing. Now let's look at the VIX. Right, so we had this little contracting pattern going on, right, where we had a series of descending highs and rising lows. Now we haven't taken out, this could be a little throw over. I'm not suggesting Elliott wave patterns occur in sequence on the VIX, but they do occasionally occur independently, right, like a compression pattern, like a triangle. So let's take that low. For the moment, we're still above that, so this could be a little throw under. Right? Often in a triangular pattern, you will go up, down, up, down, up, and then you'll break the trend line, but you won't take out the prior low. This is called a throw under, like a throw over when you go over the top, and then you'll move. So we'll see what happens over this next week. If the VIX breaks down from here, this was an irrelevant pattern. It did not have any follow through to the upside, and we have not spiked the VIX, not in any significant way. Nothing like during the COVID crash back here, or any of these prior. Well, maybe this one here, we've come a little more elevated. This is a prior low, whereas this is the taper tantrum into December 2018. Look, it wasn't a particularly high reading in the VIX. It really wasn't, but it was enough to freak the market out. We've come back to those levels, so we're elevated. Long term, still rising lows. Volatility out there in the future. But prior spikes all significantly higher than the price levels we're witnessing. Than the VIX levels we're witnessing currently. So this has surprised me during what has been a significant sell-off, that the VIX has remained suppressed as stubbornly as this. PCC has come up to where we would expect it to be during a sell-off, and the SPY has now given up high to low 24%. It's given up a quarter of its value, roughly a quarter of the global equity wealth of the 500 largest companies of the United States. So before you dismiss it as a not very significant correction, given the circumstances we're living in today, it is a significant correction. So let's sum up then. I'm not ready to flip bullish quite yet. I've become much more open-minded to it over the last few weeks, but I'm still going to maintain a bearish count for the primary because we still have data to come. We still have information on the chart which needs to be revealed to us. We have levels which need to break. Let's put that one in the alternate folder. So, speaking of those levels one more time, we've got a short-term sub-minuet way to invalidation point of 380 spot 67 for the bullish count. That is not a death knell for the bullish count. It just means short term we've counted incorrectly and we need to reconsider. The bullish invalidation point overall is 362.16. We break that. The alternate count is off the table. We did not bottom here at 362.16. Primary invalidation all the way back up here at 417.42. A 5-wave move out of the downward trend through prior resistance above this invalidation point, above the moving averages, back above the zero bound on the MACD, positive momentum in the RSI building, preferably to see overbought conditions. Okay, all of that's good. That would be a positive sign, right? Because we haven't got an overbought condition in the RSI since before the market peaked. Right, we kissed it goodbye here. So return back into positive momentum above the zero bound, big green histogram, trending higher in this downward trend on the OBV. So let's put a trend here. So we get positive momentum and positive volume moving back above this downward trend in the OBV. We do the same here in the MACD, get back above that trend, get higher readings in the MACD, higher readings in the RSI, break this invalidation point, break this channel, pull in a 5-wave impulse, and you're going to have a really hard time convincing me that we're going to go lower at that point. We will to retrace, could be all the way up to 99.9%, but that would look like a sustainable low to me at that point. So got it all to play for, and I feel like I'm waffling now, guys, so I'm going to leave it there. Thank you very much for joining me on this technical analysis of the stock market. If you're new to the channel, if you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases, and as always, feel free to leave us a comment in the comment section below. A huge thank you to my Patreon subscribers. Your support is massively appreciated. Live stream probably tomorrow on Thursday. I need to confirm with you guys over Discord. I've got a couple of arrangements I need to sort out in my private life first to make sure I've got the time. If not Thursday, it will be Friday. Either way, thank you very much, guys, and I'll be back with you soon. All the best. Bye bye.